Hello, good day. I want to welcome you to PU Prime. And in this video, we're going to be looking at common mistakes made by traders in the forex market. Now, my name is Rotimi Olawale, and I'm your instructor. Now, the first mistake made by traders is lack of a trading plan. Now, many traders jump into the market without a clear, defined strategy. Now, this is very, very common among a lot of traders. Many will just place a trade without having a reason to do so because they didn't even have a trading plan, to start with. We say here that a well-developed trading plan includes entry and exit rules, risk management guidelines, and specific goals. Trading without a plan often leads to impulsive decisions. So one of the ways to stop impulsive trading is to have a trading plan and to stick with it. If you don't do that, then you're going to have a lot of problem with trading. So you need to have a trading plan. Now, the second point here is over trading. Now, we see that many forex traders open too many positions simultaneously or trade too frequently in an attempt to capitalize on small price movements. Now, this happens to a lot of traders. Some open 5, 10, 15, sometimes 20 trades at a go. Now, this is called over trading. Now, when you have too many trades open, you are putting your account at a serious risk because if the market goes against that trade and they all become losing trade, then you have a large chunk of your account, going for it. You may even end up losing your entire account because this increases the risk and can lead to large cumulative losses. So as much as possible as a trader, you need to avoid over trading. And many times over trading even comes as a result of impulsive trading, trading with emotions, emotional trading. So you need to avoid over trading as this can lead you to losing your account. The third common mistake made by traders is ignoring economic data and news. And we say that forex markets are heavily influenced by fundamentals and macroeconomic factors like interest rates, GDP reports, and geopolitical events. Ignoring these data points can result in unexpected volatility and losses. Now, this is very common with many traders. Many don't even know they need to check a site like Forex Factory to know the economic data that will be released each day. As a forex trader, that should be your first point of call every morning. Every morning, you need to go online, check Forex Factory to know if there's going to be any fundamental event for the day. That can help you to plan your trades. Now, if you ignore this important factor and you just place your trade randomly, if data is released, from any of the countries, it may affect your trade and can turn your winning trade into a losing trade. So you don't ignore fundamental activity in the market. In fact, it is said that fundamentals override technical. So even if you have seen a technical trade, if a fundamental is released, there's a possibility that can override whatever you have as a signal on your technical trade. So, ignoring economic data can really lead to a lot of bad trades and even having losing trades in the forex market. The fourth mistake made by traders is poor risk management. Poor risk management, and it involves failing to use stop loss orders or risking too much capital on a single trade. And this is a common mistake made by a lot of traders. Without proper risk management, even a few bad trades can deplete an entire account. Now, the stop loss order is one of the simplest ways to effect risk management in trading. It simply involves going to the section on your trading platform where you have the stop loss order and selecting the stop loss on your account. And what that stop loss order does is that it reduces the risk exposure of your account. So if you set a certain limit as a stop loss, if price goes against you rather, then it's just that percentage, that is at risk, not your entire account. Now, professionally, you're not supposed to risk more than 2% of your account per trade. So if you put your stop loss in place, even if the trade goes against you, it means what you're saying is that you are willing to let go of that amount you have selected as a stop loss while preserving your remaining capital. So failure to use a stop loss means you are exposing a large chunk of your account to loss, to risk rather. And if the market goes against you, then you may have, a large chunk of that account, being at risk. And without proper risk management, even a few bad trades. So if you don't have your risk management in place, which includes your stop loss, even your lot size and many other factors, having a few trades can lead to a large chunk of account, being wiped out. The fifth point here is revenge trading. Now, after a loss, some traders make the mistake of trying to recover their losses immediately by placing aggressive trades. This emotional decision making often leads to further losses. Now, revenge trading is a common practice among a lot of traders. After a few trades, they want to double their lot size, in order to recover the previous losses and even add additional profits. Now, this practice can be very, very risky, in trading, because it's actually an impulsive way of trading, an emotional way of trading, and it's aggressive in nature. Oftentimes, that revenge trade, if it turns out to be a loss, then you discover that your loss even gets bigger than before. So revenge trading is not a practice that should be encouraged. It's something that you should avoid doing. Trade normally, use a normal risk, normal lot size, even when you have losses. Over time, you will build your account gradually. That is better than trying to practice revenge trading and having more losses in the process. Another mistake made by traders is focusing too much on short-term movements. Many traders try to catch every minor fluctuation in the market, focusing on small time frames. This scalping approach without a solid strategy often results in higher costs and losses. It is often better to look at the bigger picture on the higher time frames. Now, some people have the perception of trading, on I mean, looking at short-term movements of the markets, trading on very small time frame, like for example, the 1 minute time frame. Now, there's nothing wrong if you're scalping, but focusing too much on the short term might be detrimental, to your long-term goal and long-term profit in the forex market, because many times those smaller time frame can be regarded as noise in the market. Looking at the bigger picture can give you a better view of where the market will go on the long term. Bigger picture, like looking at the daily time frame, the weekly time frame, can give you a bigger perspective to where the market is going, and you can trade in that direction, even using the short term time frame as entry. So that gives you a better picture rather than focusing on the smaller time frame alone, which sometimes is actually a noise and may not be too good, giving you the best kind of result you desire in your trading. Another mistake made by traders is emotional trading. And this involves letting emotions like fear, greed, or excitement drive trading decisions. And this approach or this practice can be very, very dangerous and detrimental to your trading. Emotional trading often leads to rash decisions, revenge trading after losses, or holding on to losses for longer period than is necessary. So emotional trading it comes under what we call psychology. Now, when your psychology in trading is very poor, then you trade more under emotions. And with that, you can't get the best result you desire in forex trading. So, as much as possible, you are expected to keep your emotions under check when trading. So, emotions like greed, fear, or excitement should be limited as much as possible so that you can achieve your trading goal as a forex trader. The 8 point here is lack of discipline. Failing to stick to the trading plan, changing strategies mid-trade, or abandoning strategies in the face of market volatility can cause significant losses. Discipline is key to long-term success. Now, one of the most difficult things for traders to do forex trading is actually to be disciplined. Discipline is just the problem of many traders. And that's why you see some people jumping from one strategy to the other, jumping from one mentor to the other. Even the trading rule they have, they don't follow it because they are not disciplined. So if you want to be successful in trading, you must be a disciplined trader being ready, ready to follow your trading plan as much as possible. Now, sometimes some feel that the strategy they're using is not good enough, so they abandon it. The truth is that the problem may not be the strategy, but the issue may be that you are too much impatient, and you're jumping from one strategy to the other. So we need to be disciplined as a trader if you must survive in this market. And that's why the last line there says discipline is key to your long-term success in this forex trading business. The ninth point here says not understanding the currency pair. Many forex traders do not fully understand the intricacies of the currency pairs they're trading. Each pair has its own behavior, volatility, and sensitivity to certain economic data. Now, the truth in trading is that all currency pairs are not the same. Each currency pair has its own characteristics, and you must understand the characteristics of the currency pair you're trading. Some currency pairs are very volatile and some are not so volatile. Some currency pairs have low spread and some have higher spread. Some currency pairs will move better in certain market sessions compared to other market sessions. So you need to understand the intricacies of the currency pair you're trading. So you need to know what the currency pair is all about. You need to know the fundamentals that move these currency pairs. You need to know many other things that is associated with these currency pairs for you to trade this currency pair effectively. And finally, the last point here on the common mistakes made by traders is overconfidence after winning trades. After a few successful trades, some traders become overconfident and start increasing their position sizes without proper risk management. This overconfidence can lead to significant losses. Now, this is a common practice by many traders. Once you have a few winning trades, you feel you've gotten it, then you start increasing your lot size, you start doubling your lot size with the hope of making bigger profit. Now, this overconfidence many times can lead to losing your account at the end of the day. So no matter what you're doing as a trader, it's still part of discipline. Be disciplined. Don't exhibit signs of being overconfident. Go at your own pace, practice proper risk management, and you discover that over time, you're more successful. All right, so that will be all in this video where we shared on the common mistakes made by traders. The goal here is for you to be able to identify this point and be able to improve on it so that you can become a better and a profitable trader. That's all in this video. Bye.